We're going to talk about stocks, Naveed, but here's your expertise. Fixed income markets, focusing on corporate credit trading, risk management, credit derivatives, structured products. You know this stuff inside out. It actually helps with picking stocks and with equities, doesn't it? It might even be better than people that don't have an expertise there, looking at the actual core balance sheet aspects of a company. It matters, especially now.
Absolutely, we agree. I think, given the corporate landscape with leverage in many sectors nearing or approaching all-time highs, I think being able to understand the inherent default risk of any entity is key to the current markets.
I mean, just recently with the banks, we're looking at provisions and they're talking about, past and the future, but the number of companies that they've lent money to that may not survive, we really don't know with interest rates this low. Like the tide hasn't gone down where you see who's naked. I mean, there are companies that may not make it that are sort of being propped up by these low rates.
Absolutely, and I think that's one key unintended consequence by Fed policy. The amount of funding and liquidity injected to markets has really allowed many companies to lever their way through this crisis. We don't think that that's long-term sustainable, something that in the longer term will have to be resolved. I think one key about the banking system is that it's really the exact inverse. In fact, since the great financial crisis, banks have really delevered and de-risked their balance sheet. And on average today, banks have 40% more equity capital than they did in 2007, really creating balance sheets that we think should be able to weather the current crisis and economic situation.
But we're just not talking specifically about banks. I mean, default risk in this environment, you think, should be a key consideration. I don't think everyone's thinking that. I think people are still looking at, valuations based on earnings per share, things like that, revenue. You say 20% of listed U.S. companies have debt service costs that are greater than earnings. 1 in 5 can't cover their debt based on earnings. And that's something that investors should probably pay attention to.
Absolutely. I think that's the key point that we would like to make is that as you look at these balance sheets, I think people are really focused on valuation without necessarily looking at the downside risks that are inherent in some of these entities. And I think being able to find strong balance sheets in this market is really where investors will be rewarded. And that's something that we focus on significantly.
I was planning on, watching Netflix. I don't really want to do all these things you're telling me I need to do for investment. Have you done this analysis already? Do you have some stocks that pass muster with you in these contexts? What do you like?
Yeah, I think there's a couple sectors that have really taken this post-crisis, post-2008, 2009 crisis period to strengthen balance sheets, and that's the banking sector really leading the charge. But also areas associated with residential real estate and residential mortgages. In the banking sector, I think there's 2 names that we look at that are positioned very well. One being J.P. Morgan, obviously the market leader in the banking sector, but also Goldman Sachs. I think the beauty of these 2 entities is that they will be led by their investment banking divisions through times of volatility. And if there is a recovery in some of these investment banking fees and income may be declining, you have the offset where these entities can start releasing some of the excess capital that they hold, as well as a normalizing interest rate environment should, again, benefit the banks. So as you look at the profile of some of these institutions, being able to create a limited downside scenario while still having that upside is something that's very attractive to us.
You like a couple of community banks. What, Hingham Institution for Savings, is that up on the south? Is that in Hingham, South Shore?
That's right.
And then where's Greene County Bank Corp? HIFS and GCBC. Yeah, go ahead.
Yeah, so both of these are banks, community banks, smaller banks that have long-term track records of double-digit earnings growth.
Very small. Very small. We should point out, very small market caps.